A little over a year ago, the board sought comment on these two proposed rules, which would modify risk-based capital requirements for large banks. We received a great number of comments on the provisions in the proposal, as well as on the justifications and analysis that underlie those provisions. Since that time, we have been hard at work analyzing the comments and the data we collected to evaluate the combined impact of these proposals. We have spoken with a wide range of stakeholders, including banks, academics, public interest groups, consumers, businesses, other regulators, Congress, and others. And as you would expect in a project both as technical and as consequential as this one, I've had many productive meetings with board colleagues and our fellow bank regulatory agencies, the FDIC and the Office of the Comptroller of the Currency. This process has led us to conclude that broad and material changes to the proposal are warranted. As I've said, there are benefits and costs to increasing capital requirements. The changes we intend to make will bring these two important objectives into better balance in light of the feedback we have received. The changes to the endgame proposal have been a joint effort with my counterparts at the FDIC and the OCC. I intend to recommend that the board repropose the Basel endgame and GSIB surcharge rules. This will provide the public with the opportunity to fully review a number of key broad and material changes to the original proposals and provide comment. We will accept public comments on any aspect of the Basel endgame and GSIB surcharge proposals. The changes in the endgame reproposal will cover all major areas of the rule: credit risk, operational risk, and market risk. Banks with assets between 100 and 250 billion in asset size would no longer be subject to the endgame changes, other than the requirement to recognize unrealized gains and losses of their securities in regulatory capital. These changes reflect the feedback we have received from the public, improve the tiering of the proposal, and better reflect risks. I will also recommend changes to the GSIB surcharge proposal to better align the capital surcharge for a GSIB with its systemic risk profile. Taken together, the reproposals would increase aggregate common equity Tier 1 capital requirements for the GSIBs, which are the largest and most complex banks, by 9%. For other large banks that are not GSIBs, the impact from the reproposal would mainly result from the inclusion of unrealized gains and losses on their securities in regulatory capital, estimated to be equivalent to a 3 to 4% increase in capital requirements over the long run. The remainder of the reproposal would increase capital requirements for non-GSIB firms still subject to the rule by about 0.5%. While these proposed changes affect some of the most important aspects of the proposals, the agencies have not made final decisions on any aspect of the proposals, and that includes those are not explicitly addressed in the reproposal. The public should not view any omission of a potential change in these reproposals as an indication that the agencies will finalize a provision as originally proposed. We continue to consider comments already received on the 2023 proposal, and we will consider those comments together with any comments submitted on the reproposals as part of any final rulemakings. This is an interim step. Let me reiterate that we are open to comments on any aspect of the proposals.